Welcome back to another episode of Palisade Radio. I'm your host, Karema Mutlu, and on today's show we have Luke Gromen, the founder of the macroeconomic research firm FFTT. How are you today, Luke?
I'm doing great, Kerem. Thanks for having me on.
Let's start by talking about your background within the finance markets and your philosophy on how you gather research to develop your macro themes. Can you give us a sense of what you look for within an investment theme?
Yes, absolutely. So my background is that I started off my career as a research analyst at a regional institutional brokerage firm in Cleveland, Ohio, and then switched over to institutional sales. And so I was calling on large institutional accounts, and we were pioneers, early pioneers in doing very deep in the weeds, survey-driven, bottom-up research. And early on, was one of the founding editors of a thematic product that we would do, that I would write every Friday for our customers around the world, that was basically aggregating the bottoms-up data points that we were picking up in our research, and then marrying those data points with top-down macro and thematic reading I was doing on my own time. And it ended up being a really popular product for the firm. I reprised that role at a firm that I started with 20 partners of mine about a decade later. So I spent nearly 20 years really on the institutional research side. And then in early as the equity markets became more and more macro and central bank driven after 2008, I was spending more and more of my time doing that type of work. And came to 2013, late 2013, I went to my partners and said, hey, I'd like to focus on this macro product full time. And they said, hey, we'd love to have you do that. Obviously, the product's been very successful. And I said, well, one caveat to wear that hat is that I would want to have complete creative control to write whatever I wanted to write, because I felt like that was going to be very important in terms of the way trends were heading, that we were heading into a period of time where things were going to be quite interesting, shall we say. And at any rate, from a merchandising or marketing product positioning standpoint, they sort of had a hard time figuring out how to place that product in the, what they were known for, which is very deep in the weeds, just terrific bottoms-up fundamental research. And so we amicably parted ways in early 2014, and I hung out my own shingle as FFTT, or Forest for the Trees. And it brings me to the point of your question of how do we, our process. And the process is we aggregate a large amount of publicly available data points in an unconventional manner. And what we're really trying to identify are developing economic bottlenecks in different sectors, industries, macro themes. And the way we aggregate them is we just intake. I've equated myself to sort of being a big catfish down at the bottom of a river and waiting for things to kind of drift downstream. And we just read a lot, hours and hours and hours a day. And when something grabs me that is of interest, it goes into our cutting room, what we call our cutting room. And that's sort of where the, a little bit of the art of the process is, I guess, if you will, which is, I don't know why, I'm not looking for any specific theme or what have you. I'm looking just for things that kind of grab my attention. And so once something grabs my attention, it goes in the cutting room. And when it's time to write, and we write a full page piece every Thursday, along with a couple other products during the week as well, we go to the cutting room and we kind of see what the data are dictating to us, what's bubbling up. And historically, where we get really excited to explore and write about a theme is where the data are saying one thing at a time when consensus in the markets is heavily favored to something entirely different. And so that's sort of the process in my background.
Very good. So, Luke, let's get your current thoughts on gold, especially regarding the recent price action since the beginning of the year. I recently saw on your Twitter account some comments referring to central bank buying. Can you expand on that and what this means for gold going forward?
Absolutely. So, as it relates to gold, I think two overriding things, I guess, when I think about gold. Number one, I think in a global everything bubble, I think gold is one of a very small handful of assets. I think gold is arguably one of, if not the cheapest asset on the board relative to history. When you look at the valuation metric of gold that I use, I mean, you get some people saying, "Well, I can't value gold. I don't know how to value gold, so I won't buy it," and particularly here in the States. And I don't think that's right at all. I just think the valuation of gold doesn't matter for most of the long economic cycle. But then at the end of the long economic cycle, when you get into a global sovereign debt bubble like we're in now, which only happens once every century or so, then it's really important to understand where gold's valuation is. And that valuation that we look at and you can look at it against a number of different debt metrics, sovereign debt metrics, et cetera, monetary aggregates. What we look at is the market value of the United States official gold, the 8,100 tons that the United States owns at market price. And then we look at that relative to the amount of foreign held U.S. Treasury bonds outstanding. And the reason we use that valuation metric is because the dollar is obviously the world's reserve currency. The Treasury bond has been the world's primary reserve asset for the past almost 50 years. And so historically, the market value of gold, of the U.S.'s official gold as a percentage of the foreign held treasuries outstanding has, before 1989, it was never less than 20%. That ratio was never less than 20%. In the early 80s, during the last peak in gold, that ratio was about 133%. In other words, foreign creditors, had they wanted to, could have taken their treasury bonds, presented it for gold payment at the U.S. If there was a gold window, they could have taken every treasury bond in gold, and the U.S. still would have had a third of its gold left over. In other words, U.S. foreign held treasuries were 133% gold backed effectively back in the early 80s. That's a gold bubble, right? I mean, it shouldn't go over 100% unless there's real concerns about the currency, and there were real concerns about the dollar in the early 80s. So 133% in 1980, never below 20% before 1989. Where's that number today? It's about 4 or 5%. And so that's why we say, for us, gold is one of, if not the cheapest asset on the board, both because of that valuation, but also because of where we are in the long cycle, by virtue of being in a global sovereign debt bubble. Now, that's the first way we're thinking about gold. The second way is that you cannot look at gold markets without understanding the gigantic paper gold market that is attached to it, and the political purpose of the gigantic paper gold market that is attached to it, which is ultimately to dilute the demand for physicals. And the reason we say that, there was a U.S. State Department WikiLeaks press, the United States State Department brief from 1974 that WikiLeaks released. It's now declassified, and it says that it would be really nice to have a really big gold futures market, because that would reduce American demand for gold and help manage the price over time. And so, there's always this debate that, is the gold price manipulated? Is it not manipulated? And I think that misses the mark. The point is that the fact that you have a cash settled futures market, paper market on a monetary asset, that the existence of that cash settled futures market without any limits on leverage, that is the manipulation. And so you have to understand, and so where that leads us to, and what we've been on record saying a number of times, is that gold is not a real market, and it hasn't been a real market for at least 5 years, in terms of when you look at what has been happening with physical flows relative to the price of gold. And so as I think about gold, what we've seen year to date, it's been very interesting to see just the change in physical flows relative to what we saw last year.
You've said in the past that the most undervalued assets on Wall Street are history books. Can you talk about that and how this plays into your research and how you view the markets?
Yeah, I do think they're one of the most undervalued assets on Wall Street, and the reason I think that is most market participants seem to view history as linear rather than cyclical. When there's a large body of evidence to suggest it is in fact cyclical, right? One of the great phrases on Wall Street, right, is it's never different this time, or that it's different at this time, or the four most dangerous words in investing. And the reason they are is because history does rhyme. And so now there are always differences, and the trick is taking the analogs of history and understanding the changes to technology or market structure, geopolitics, and understanding how to adjust for those. But ultimately, the human emotions of greed and fear drive markets, and greed and fear have been around for millennia, and they'll be around for millennia more. And that's why ultimately humans tend to react to the stimuli of the time. Whether the technology is AI or social media, or whether the technology is, going from 90% horse-drawn buggies in New York in 1910 to 90%, automobiles in New York by 1920. That was every bit as big a change as some of what we're seeing, to the people that lived at the time. And so there's always been growing technology, particularly over the last 300 years, rapidly growing technology. We can make the case, okay, the world is more connected than it ever was. That's an important adjustment. The technology is moving faster maybe than it was. I think that's an important adjustment. The geopolitics are different in certain areas that you have to make adjustment for. But ultimately, you can look back to history and see some similarities, whether it's levels of sovereign debt, whether it's tensions between the U.S. and China, whether it's guns and butter deficits in the U.S. in the late 60s versus some of the things we're doing now. And so when you look at these things, they can lead to better informing of the range of potential outcomes for your investment process.
Excellent. Let's get your current thoughts on the tensions between China and the US in terms of trade, but also in regards to the Chinese economy slowing down. Is a global recession a likely scenario after so much money printing and excessive debt from both nations?
I think that the tensions between the U.S. and China are unlikely to get better. I think it's a matter of national security for China to not change the way they're doing things and accomplish some of the things they're trying to accomplish. I think it's a matter of national security for the United States to get China to stop trying to accomplish what they're trying to accomplish in terms of gaining more monetary sovereignty and the ability to print yuan for critical imports of commodities and oil. And so you've got two major powers who are really tied at the hip economically. And it's a matter of national security for both not to cede really anything to the other. And it ties back to this point about the history books. I mean, we've seen this before. We've seen this before a number of times. And Graham Allison wrote about it in his book, Thucydides' Trap. To me, the last time we saw something like this was the UK and Germany from, call it 1870 to 1910. And the economic competition and that ultimately led to World War One. And so I don't think, and this ties into my point about the history books being undervalued, the level of complacency amongst U.S. investors in particular, but I think global investors more broadly, particularly in the West, I think is surprising to me at this point. They really I don't think they see things through the national security lens of either China or the US. And if you do, you start to realize that someone's going to have to make a very, very big concession, neither of which will significantly alter the balance of power between the two and globally. And it doesn't seem likely that either wants to do that. And so I'm unfortunately, the longer this drags, starting last year, about a year ago, we were writing about the real change in tone from the U.S. towards China. By middle of last, by second quarter of last year, we were saying, hey, we're concerned the U.S. may be willing to burn down the world effectively in order to basically not allow China to accomplish what it wants to accomplish. And by third quarter last year, we just said, Graham Allison was quoted, and we're taking this quote from him. The trade tensions between the U.S. and China are going to get worse before they get worse. And I still think that that's the case. In terms of what that means for the economic outlook and a global recession, ultimately, all of this, if tensions between the U.S. and China keep rising, as unfortunately I increasingly think they will, that's good for the dollar, that's good for gold, that's good for U.S. Treasury bonds for a while at least, and it's not good for much else. To the extent the dollar rises, it then sets off a race of basically, everybody who is short dollars in a major way through U.S. dollar denominated borrowings from China and emerging markets to U.S. corporates to the U.S. government itself. It's a big race, basically, who hits the wall first. And the bottom line is that unless the dollar is significantly and structurally devalued via a Plaza Accord or a new Bretton Woods type deal as part and parcel to a Chinese trade deal, I don't think the outlook for economic growth is very good at all, because again, U.S. and China are tied at the hip economically, and if China sneezes, right now it seems like the consensus is that the U.S. will somehow prove to be immune to catching a cold or worse, and I just think that is highly unlikely given again historical experience. From the late 90s. I remember when Asia Pac was 5% of sales for a lot of industrial companies in the U.S. It slowed meaningfully in the late 90s with the Asia Pacific crisis, and the consensus at the time was, well, these industrial companies in the U.S. will be fine because it's only 5% of sales, and 6 months later they were all in a recession. And China's obviously a lot more than 5% of anybody's sales, and so to think that if these tensions are going to get worse and the dollar's going to rise and keep short squeezing people, then there's just it's not a good setup for risk, broadly speaking.
As we wrap up the show, Luke, is there anything else you wish to discuss today?
No, I'm just really watching these. To me, I think the markets are increasingly moving towards almost a one factor model, maybe a two factor model. Which the one factor model is the dollar. Everybody's short dollars, and there's a whole lot of things going on geopolitically and economically to try to make those dollars more scarce, and then it comes down to who's most short dollars soonest. And if that's China, then that's one set of issues followed by another set of issues, and if it's the U.S. government, then that's sort of a similar set of issues. It's just the order changes, and that to me is the big thing to focus on. And so I think that the trade tensions, the trade side is really the key to watch vis-a-vis the dollar at this point going forward, until further notice.
Okay, well, thank you very much for your time today, Luke, and I'm sure we'll have you back on the show again very soon.
That sounds great. Thanks for having me on.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be? It actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?